Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, March 20th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant theme this week continues to be the impact of the Iran conflict on global markets, and we're seeing this play out across multiple asset classes. Energy markets are front and centre, with Saudi Arabia warning that oil could spike to $180 per barrel if this energy shock persists past April. We're already seeing crude prices elevated, and the International Energy Agency is calling for measures like working from home and reduced travel to tackle what they're calling an energy crisis. This is having real knock-on effects. UK household energy bills are projected to rise by £332 due to the war driving up prices, and UK borrowing costs have hit their highest level since 2008 amid this inflation shock. What's particularly notable is how this is creating a stagflation scenario that's putting banks in a difficult position. On the geopolitical front, Trump has invoked emergency powers for $23 billion in Gulf arms sales, and there are reports he's mulling new measures targeting Iran's Karg Island oil facilities. The luxury goods sector is also feeling uncertainty, with Zegna's chairman stating that the war has made luxury demand highly uncertain. Meanwhile, we're seeing some defensive positioning, with gold getting attention as an investment option, though there's also discussion about whether cryptocurrencies like XRP might outperform precious metals in this environment.
That's painting quite a complex picture. How are you reading the market's interpretation of all this? And what does it mean for traders looking at next week?
Markets are clearly in a risk-off mode, but there's an interesting dynamic developing. We saw bonds and stocks both decline this week as Iran sustained attacks, and emerging market stocks ended the week in the red as oil concerns rise. However, there's a contrarian view gaining traction that peak uncertainty about the Iran war could actually signal a stock market rally may be near. The thinking is that once we reach maximum fear and uncertainty, that's often when markets find a bottom. For traders, the strategy advice I'm seeing is to avoid gimmicky approaches and overheated assets. The focus should be on quality companies that can weather higher input costs and pass them through to consumers. Energy sector exposure is obviously worth considering, but be careful chasing prices that have already run significantly. The defensive plays like consumer staples and healthcare are getting renewed attention, and there's been discussion about the best healthcare stocks to buy after this market pullback. India's central bank is actively battling to protect the rupee from the Iran war fallout, which tells you how widespread these effects are. For the week ahead, I'd be watching oil price action very closely, as it's really the key variable driving sentiment across equities, bonds, and currencies right now.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like from the data we've seen this week, and what should we be watching?
Thanks, Robert. We had several important releases earlier this week that are worth highlighting. On Wednesday, March 18th, we got the Federal Reserve's rate decision, which came in exactly as expected at 3.75%, unchanged from the previous meeting. This marks the third consecutive meeting at this level after the Fed cut rates from 4% back in December. Also on Wednesday, we saw the Producer Price Index come in hotter than anticipated at 0.7% versus the forecast of 0.3% and the previous reading of 0.5%. That's a concerning acceleration in producer inflation that could filter through to consumer prices. Then Thursday, March 19th, initial jobless claims provided some better news, coming in at 205,000, below the forecast of 215,000 and down from 213,000 the prior week. That suggests the labor market remains relatively tight despite everything else happening earlier in the week. On Monday, industrial production showed strong growth at 1.4%, up from 2.33% previously, indicating manufacturing activity remains solid. We also got factory orders on Wednesday showing a modest increase of 0.1%, matching forecasts and following a 0.4% gain previously. Now looking at today, Friday, March 20th, there are no major economic indicators scheduled for release, which gives markets a bit of breathing room to digest this week's data. The combination of sticky producer inflation, a resilient labor market, and solid industrial activity suggests the economy is holding up reasonably well, but that inflation battle isn't quite won yet, which complicates the Fed's positioning going forward.
That inflation data is certainly something the Fed will be watching closely. Lizzie, let's shift to crypto markets. What are the trends you're seeing for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is showing some interesting divergence right now. Starting with Bitcoin, we're seeing a critical battle playing out at the $70,000 level. BTC has been defending this support, and there are some early bull market signals emerging, according to Glassnode, though they note that confirmation is still lacking. What's concerning some analysts is that Bitcoin's current price action looks dangerously similar to the pattern that sent it crashing to $60,000 previously. We saw Bitcoin jump to $70,800 earlier as oil retreated, but it struggled to hold those gains. There was notable whale activity this week, with a Bitcoin OG moving 2100 BTC that had been untouched for over 13 years, selling about $72 million worth. On the institutional side, though, we're seeing positive developments. Morgan Stanley advanced their Bitcoin ETF application with an amended S1 filing, setting the ticker MSBT with $1 million in seed capital. Coinbase and Apex Group tokenized a Bitcoin yield fund on Base, and corporate treasuries continue accumulating with DDC, adding 200 Bitcoin and Strive adding 317 BTC. The sentiment for next week is neutral to slightly bearish, as Bitcoin faces potential downside if it can't hold 70,000, but longer-term institutional adoption trends remain constructive. For Ethereum, the picture is more bullish. ETH is forming a large cup and handle pattern that could target $3,000 on a breakout. We saw a whale transfer $111 million in Ethereum, and Europe's largest asset manager, Amundi, just debuted a $100 million tokenized fund on Ethereum and Stellar. Ethereum's ecosystem continues to show strength with real-world asset integration, as EtherFi allocated $25 million to Plume for yield generation. The technical setup suggests Ethereum could see upside momentum next week if it breaks out of this pattern. Solana is the weakest of the three right now. Solana DApp revenue has fallen to an 18-month low, and Sol price risks retesting the $80 level. Forward Industries, a Sol treasury holder, is using crypto-backed debt from Galaxy to buy back shares as the treasury faces drawdown pressure. The declining DApp revenue is a real concern for the ecosystem's health, and the sentiment for next week is bearish, with Sol potentially seeing further downside. Overall, institutional adoption continues for Bitcoin and Ethereum, but near-term price action remains choppy given the macro uncertainty we discussed earlier.
Appreciate those insights, Lizzie. That wraps up today's Morning Bell, as we head into the weekend with oil markets and geopolitical tensions still elevated. Remember to do your own research and consult with financial advisors before making any investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell wherever you get your podcasts. I'm Robert, and we'll see you next week.